Give it one more minute and start at noon straight up. I'm sure people will be joining us as we go along. So Larry Steinborn says, congrats, Steve, on the Tom West Award.
Oh, thank you, Larry. I appreciate that. Yeah, that was a surprise to me.
Awesome. Congratulations.
I'm incredibly honored to be amongst the other recipients of that award over the years. And, you know, it's just, I was shocked. Had no idea. I just enjoy doing this and enjoy giving away information and enjoy helping other people. That's really what drives me.
And you've been doing a lot of that lately, and we sure appreciate it.
Yeah, thank God my staff is so wonderful here and is handling everything behind the scenes. Just telling somebody yesterday, you know.
We've got a pretty good crowd on joining us, and it keeps clicking up and up. We'll give it maybe 30 more seconds, and we'll get going. So just some basic stuff to get us started. So my name's Scott Cronk. I'm a business broker here in Austin, Texas. I'm the president of the Austin Chapter of the Texas Association of Business Brokers. And we're really happy to be able to host this webinar / chat / Q&A session with Steve today. We're going to go through a bunch of stuff, and if you have questions, if you don't mind, you can go ahead and type it into the chat bar or the Q&A bar. You find that by taking your cursor, bring it down to the bottom of your screen in the middle. You can hit chat. I'll be monitoring that, and we'll kind of break in and deal with that. So Jeff Elder says, put on a good one, Steve. So just like Jeff did, or like Larry did, congrats, Steve, on the Tom West Award.
Thank you.
So that's how we'll manage it. Steve and I are unmuted. Y'all are muted, and we're likely going to keep it that way just so we can get through this. We're scheduled for an hour. We're going to try to keep close to the hour that we can while trying to get through it all. So yeah, with that, I'm going to turn it over to Steve a little bit. Those of you who don't know Steve, you really need to. He's the founder of Diamond Financial Services. You can find their website at diamondfs.com. A ton of information there. He's been involved in small businesses since 1978, personally owning many himself. It's his experience in locating financial solutions that brought him to establish Diamond Financial with the business owner in mind. So Steve and I have talked a couple times, and thanks for Jeff for connecting us. We're going to talk. I kind of put this in 5 buckets, if you will, and we'll try to get through the 5 of them. But you know, kind of the current status of SBA lending, impacts from the PPP, what happens if business valuations are coming in lower than deal price. We've got potentially lower real estate valuations. I did ask Steve to look into his crystal ball and get his thoughts on the business acquisition industry for the next 6 to 12 months, what it's going to take to get deals done. Talk about creative financing alternatives and the forgivable promissory note, which I believe Steve is the father of. And a couple other things we want to talk about before the day's over, which is business brokers and talking to your sellers about the impacts of the current market on deal completion, and then questions every business broker should be asking your lenders. As a business broker, you certainly should have lender relationships. It's a great time to enhance those relationships, but there's definitely questions that y'all need to be asking your lenders at this time with the goal of getting deals done. So with that, I'm going to go ahead and turn it over to Steve.
Well, thank you, Steve, and I appreciate the opportunity to speak to all your members, or a lot of your members, and anybody else who's joining us today. Basically, the information that I'm working on and I can talk about me, but it's really not about me. What's important today is, you know, the world that we're living in and creative financing and really thinking outside the box, I think, over these next few months, because I think that's what it's going to take. Now, one of the things that I also recognize as a small business owner, having lived through the last 25 years in this industry, is it is the small business owner and the business brokers that drive this economy. So, you know, I can't stress that enough, that I'm counting on everyone on this call to help get this country through this. So I'm hoping that some of the solutions or avenues that I discussed today give you more arrows in your quiver to try and get deals done over these next couple of months. There's going to be a lot of information that I'm going to throw at you. A few of the things will be a few of the SBA rules that people may not be aware of or hadn't considered over the last few years, because it wasn't as important as it might be today. So I am going to touch on just 3 quick SBA rules so that you're aware of them. And one, like Steve mentioned, relates to business valuations and appraisals and asset balance sheets. So we'll talk about that, and we'll talk about, like I said before, the forgivable notes and seller earnouts and things like that. Seller financing, for those of you who have spoken to me in the past or known me for any length of time, I'm typically anti-seller financing. If you know Ed Pendarvis, me and him have had that ongoing argument for probably 20 years already. But guess what? It might be right these next few months. So we'll talk about some of those things. So we're not going to specifically focus on SBA today. What we're going to do is really look at avenues of being creative and getting deals done moving forward. That's what's important. So some of today's topics, personal pledging of collateral for high net worth clients, that may be important as the lenders tighten up and change and things like that. So I want to make people aware of the collateral, because as there's more concerning either businesses out there or lack of lenders or whatever else, you know, collateral is always the first place they run. So we'll talk a little bit about that. We'll also talk about the SBA balance sheet requirements, because this again affects the collateral position, and you should know what those are as you're moving forward if you're looking for any kind of a lending arm or piece to help your transaction get closed. Then we're going to get into the business valuations and appraisals, and then finally some of the CARES Act and some of the things that you're going to be exposed to over the next few months, whether it includes financing or not. It's just going to be things that are going to be included in your transaction on some level typically. And I'll share some of the things that we've lived through here in our firm as we've closed transactions through the CARES Act. So those are the outside of the topics. This is one that's near and dear to my heart, because we work with a lot of high net worth borrowers, and I did change this a little bit for Texas, because every place else we take a house, even Florida, who has a homestead rule, but not in Texas. Okay, so now the reason I put only a primary residence is many of my high net worth clients have 3, 4, 5, 6 houses, mainly, you know, around here or on the coast or in the mountains. So Texas, the only thing that is excluded is their primary residence. So if they do have other real estate, you need to understand that and know that it may be a bigger piece of the puzzle moving forward, which is typically not what I speak about. I usually keep the collateral requirements to a minimum. Okay, so the answer is, will you have to pledge it? Maybe. You know what? And maybe we even go past the rule because we want the deal to get done. So there's going to be a lot of moving pieces these next few months. So to truly determine the borrower's house must be taken, here's the actual rule. If the house, and this is excluding Texas, let's talk about maybe a rental property or an additional building or something else that a potential borrower in Texas might own. If that property has less than 25% equity in it, it does not have to be taken for collateral. Now, that's an optional rule, which is why I'm putting it out there. Okay, so what may have been avoided a month, 2 months, 3 months ago, I might say, yes, we only have 20% equity, but I'd like to give that to the lender this time to help make the deal happen. Okay, where I normally run to immediately protect everything I possibly can. And, you know, my lenders will tell you that, hey, if it has 24% or less equity in a house, I'm going to insist they leave it off. But this day and age, it might make the difference. And that's the only reason why I'm bringing it up. So what's considered liquidated collateral value? So they discount the house by 25%, then they deduct your first mortgage, and that becomes the liquidated collateral value number. But it still may be a deciding factor in these coming months. So you should understand at least this rule or know, if a lender comes back to you and says, hey, we need a little bit more collateral, maybe you do explore the house or his second property or anything else. So this is the actual rule. SBA does not require a lender to collateralize a loan with real estate when the equity in the real estate is less than 25% of the fair market value, okay? Like I said, it's always been my backdrop, which is leave the house off. These coming months, I don't know where it's going to be. So it's a rule that you need to understand, because you can't actually offer up the house even though it has less than 25% equity. Now, again, you can't in Texas. Even if the borrower has no mortgage and he allows the lender to take a lien on it, you can't still do it in Texas. So this would only apply to their second rental properties or any additional properties that they own. It's never going to apply to their personal residence, even if they wanted it to, and the borrower allowed them to, they still can't. So there is no, if there's less than 25% equity, it does not have to be pledged, but it's something for you to know if you're going to work with financing. This is a rule that comes up all the time that people are not aware of that really will affect moving forward. So, asset value balance sheet rule. And this is a rule that's been on the books since about 2012. Okay? So how could this affect my listing and closing? Well, if SBA funding is being considered, price allocation may have to change right before the closing. And this is really twofold why it matters. When you take an initial listing, one of the things that I see happen all the time is you go through the factory or whatever particular business it is, and you're talking to the seller trying to determine, well, what are the fair market value of the assets of this company? All right. And many times, which is correct, you looked around and you can determine really the asset value or close. In this particular example, all right, he has land of $1 million, buildings of 2.3, but he has accumulated depreciation of 1.5. which leaves $800,000 worth of actual depreciated asset value. Now, why this matters and why I'm bringing it up today, because like I said, moving forward, I see already lenders' handwriting on the wall, tightening up down payment levels, collateral levels, and a lot of other things. But this is a problem because, let's see, this particular firm where you might advertise having it at $1 million in the buildings and equipment, $4 million. The accumulated depreciation on that equipment is $1.8 million. So you may understand and talk to the seller and understand that there's a $4 million worth of equipment in there, but if the balance sheet is showing 2.2, you can't change that unless you get a full-blown equipment appraisal. Now, why this matters is if you're listing this business and you're listing it with equipment at $4 million, a lot of times this doesn't come out until you work on the purchase price allocation, which is close to the closing while you're finalizing your purchase contract. And if you did list $4 million and then the buyer actually finds out, well, based on the SBA loan, I can't list that equipment more than 2.2. It changes not only the collateral position of the lender, but it also changes the depreciation values of the buyer. So this is an important rule that I see come up a lot of times, especially when it's a stock sale, because he's inheriting that balance sheet. But what the actual rule says, it must match the accumulated depreciation values on the most current balance sheet or trump it with an appraisal. Well, many times on a business like this, where there is a lot of equipment, might be worth getting an appraisal. But this is something you need to understand because you don't want to have to address this 2 weeks before the closing. And it might be
one of the questions related to all this is, it seems like the sense is that, right, you feel the banks are going to be a little more skittish and things are tightening up. Do you think the government's going to be encouraging the banks to loosen up? And what do you think that dynamic's going to be like?
Well, I would love that, and I did help create a petition that would increase our guarantee limit from 75 to 90, which would do exactly what you just described, but there is no talk of that on the horizon. There was, and it went and came twice already during all of these talks with the government, but there's nothing that's finalized trying to increase the appetite for SBA lenders to write loans. So what I am seeing right now with the lenders, and And we typically only work with 6 to 8 lenders at any given time. We don't keep more than that in our portfolio. But we lost three and a half of them. So we are only down to 3 or 3.5 lenders here at our firm. And with our high volume level, they should be, no problem for us to get, but it is a problem. So that's why I'm bringing this up. And what they're describing, to your point, is increasing down payment values and amounts, looking for some seller financing now in my transactions, which again, if you heard me before, I'm against. And they're also looking for collateral. So those are the 3 pieces that have tightened up, or, and right now you have to understand the lenders don't know where it's going to wind up either. So I'm saying this as their default skittishness. They're just running right to, well, let's tighten up a little and then let the dust settle and figure out where we are. But I do see it's happening on the few lenders that we still have, not to mention all the rest across the board. So, and that's why I'm bringing out this asset value rule, because this might be a great thing when you're going to a lender and you can say, here is your liquidated collateral values, here's your collateral positions, here's what you have, and your exposure is only X or Y. And it is going to be a combination of that seller financing and the higher down payments, and it's going to be the collateral. So these are pieces that I think that everybody needs to be aware of as we move forward through these next few months, at least until the lenders do lighten up. And what happens is when there is less lender competition, which is what market we're in right now, the ones that are still standing can almost make their own rules. And that's what I see happening a little bit. So like I said before, as a default, they're just tightening up a bit. So this is something to be aware of. You must use the depreciated. Now, a lot of brokers will ask me, well, should I go to the balance sheet when I'm listing a business and put fair market value in as the depreciated value? I don't think that you should. I don't think that your listing should change. I think that you just need to be aware that if it's an SBA type financing included, that this is going to affect your balance sheet and your purchase price allocation moving forward. So a lot of times when I see a company like this where there's $1.8 million worth of depreciated collateral, I know it's in equipment. I'm going to order an equipment appraisal because they're not very expensive and it could add a ton of money and collateral to the transaction. So that's really why I'm bringing it to everyone's attention. Collateral may matter in the future. Keep that in mind. Okay, so this buyer just lost $650,000 of initial depreciable assets when it was all said and done. So he's not really typically happy about that. And there again, the lender might not, if you told them that there was $4 million worth of equipment, they're not going to be happy either because they think they lost it too. So that's why this is an important rule to notice. Now here's one that has been a hot topic these last, 2 months as far as webinars go. For those who have heard a lot of the valuation firms on the webinars, I've been able to join a lot of them, and their concerns is the valuations are going to come in low. I already see appraisals starting to come in low, but they're already putting it out there and warning everybody, understand valuations are going to be severely impacted by these few months. Well, so what if either of these come in low? What does that mean to you? Well, it might not be a concern at all. Don't know. So we're going to go through that, and I'm going to teach you a little bit about why it might not be an issue. This is critical information also if you're going to use SBA financing. So here's the valuation rule. The valuation rule says that 7(a) loan proceeds used to acquire a business cannot exceed the appraisal of the business. Well, what that means is the business valuation must be less than the loan amount. Does not have a relationship to the selling price, which is a big change. So this was different before 2000, I want to say 12, don't quote me, but I do believe this was in reaction to the 9, 10, 11 crash, where all the valuations and appraisals were coming in low. So the SBA said, hey, as long as we're not financing anything over the valuation number, we don't really care how you pay for it, which was a change because prior to that, the valuation had to meet the purchase price or the purchase price had to be adjusted. Well, now they're saying, hey, if you can fix the difference between seller financing and down payment or whatever else, that's up to you. As long as our loan amount is less than the valuation, it's not going to be a problem. So if we're talking about, let's just say $1 million purchase and the valuation comes in at $800,000, well, don't forget you have seller note and you have the down payment that could make up those there's going to be a down payment level. If he was putting in 20% already, he's putting in 200,000, and the valuation's not a problem at that point. So these are things that you need to be aware of, especially when it comes to the valuation. Also, this is an optional rule that there are lenders that don't choose to accept. So again, going back to what Steve said before, as far as your lender relationships, this is something worth a conversation with your lenders. Understand where they stand on this rule. Will they accept this rule, or have they ever used it before? If their policy is absolutely not, and that valuation must meet the selling price or we're out, well, that's going to help you determine what lender to use as you move forward. But this is, again, an optional rule, and there are lenders that will choose not to use it. But it's important for you to know there is some wiggle room on the valuations.
Steve, going back to equipment, who directs or who chooses when somebody's going to order an equipment appraisal? And is that, sounds like that's not automatically done by the lender as part of a typical business appraisal. So that's one of the questions, like who decides on that, and how does that get done? Great question. It's a little bit different rule than it is the valuation. So the business valuation and appraisals must be ordered, paid for, and property of the lender. When it comes to equipment appraisals, as long as we're working with a higher level firm, then usually we can order it up front. If I recognize this as a major concern, I'm going to suggest it to the broker, buyer, and seller in the beginning, so that we can all get on the same page, especially if it matters to the lender. Now, going back to who orders it, if the lender recognizes that there might be a lot more collateral value here than they're understanding at that point, they could order it. So anyone could really demand it. It isn't a requirement for SBA, though, to close the loan. So it is kind of optional. So it's whoever thinks that there might be a value or a reason to do this, they can order it. And like I said, we'll pre-order them up front many times so we understand. And it's important, if this comes back at $4 million worth of equipment, the loan's a lot more attractive to a lender. So if I recognize that this 2.2 worth of equipment might be valued at $4 million because it's only a year and a half old, or maybe it comes to, with the 179 expense depreciation, they can write off so much that first year, it could be brand new equipment. So that's what we're all going to talk about. And if it's worth it, typically an appraisal is $750, maybe $1,000 if it's normal equipment that they can do via desktop. Sometimes it's a no-brainer. If we're only talking about a couple $100,000 difference, it may not be worth it. But so it's up to whoever. If I'm working on this transaction, I'm recognizing it and bringing it to everyone's attention and letting everybody else decide. If the buyer says, I'll accept the 2.2 value on the equipment, well, that's half the battle. If the lender says, hey, we can do the deal with 2.2 worth of equipment, then I'm fine with it. And I can avoid the equipment appraisal. But if I think it's going to help our transaction or help it get approved, then I'm doing it up front. So I hope that answers the question. Okay, the appraisals on real estate. Now, here's the rule on the appraisals on real estate, because we see these coming in all over the map too. What I struggle with when it comes to commercial real estate appraisals is there are so few appraisal companies on each of the lenders' lists that they could be sending them from Illinois to New Jersey to look at a property. Well, they don't know the property. Here the Outer Banks is different than the mountains. And a lot of times they'll use an appraisal firm that is most available to them or cost effective, but don't know the area. So here's the rule on the appraised values. If 90% or more of the estimated value, so if it's $1 million piece of real estate and it comes in at 900 or more, the lender can go ahead and close the loan with no concern. Okay, so they give us a 10% window where there is no concern on the real estate appraisal. So if it comes in, at 925 and it's selling for $1 million, the lender can go ahead and just close the loan with no concern at all. But there again, this is another rule that's optional and up to the lender. The lender could come back and say, no, we want to see that valuation at $1 million because that's what you're paying for it. But another rule that we use all the time here. So if it comes in at 90%, actually it goes on to say if it comes in at less than 90%, you can still go ahead and close the loan, but you have to document the file exactly why you think this appraisal come in low. So I try not to
to get them to do it. You know, if it comes in less than 90, we're going to figure out a different plan. So these 3 rules are critical, I think, moving forward, as these appraisals, valuations, and collateral positions are affecting our transactions moving forward. So now we're going to talk about getting creative with finance and outside of the SBA, and including earnouts. Earnouts was something that were outlawed by SBA, I want to say in 12 or 13, and we'll talk about why and things like that. So let's talk about earnouts, which I was not against and used quite often in a lot of the transactions that I've done. Usually I see it for typically fast-growing companies. One of the biggest earnouts I ever wrote, the company had outgrown the seller. And then he signed a new business-to-business contract that would have almost doubled the business. And he knew he couldn't live through it. It was just too big already for him. We had a high-level executive coming in to buy the company, which was the perfect scenario because he could handle such a thing. And everyone recognized the seller should be compensated for this new contract that he just brought in because it's going to add hundreds of thousands to the bottom line. So, you know, those were scenarios where I used earnouts. I used them in quite a few of the different scenarios. So they just secured new, larger contracts, used to reduce down payment and buyer's exposure. So this is what we used to use it for. When there was a bit of a concern on a business, we used to take, let's just say it was a $2 million acquisition, but there was $500,000 in question or concerning to the buyers and the sellers because of whatever scenario. Maybe it's customer concentration, whatever it is. I've had an earnout tied to employee retention in the past. But what that used to do on, let's just say a $2 million acquisition, if we put 500 into an earnout, it would then also reduce the down payment because the purchase price was then $1.5 million. And that's one of the issues that SBA had with earnouts. And I'll talk about that in a second. So customer concentration, you know, any major concerns I used to put into earnouts. You know, hey, we're happy to give the seller the money as long as the company does fine. I would always tie them to gross revenues or something that was not adjustable by the buyer. But earnouts then became ineligible for SBA financing. Still, I think a very valuable tool and something that's going to come into play these next few months. I have one we're working on right now. It's a very large transaction where the landlord is the seller and they're tying the lease payment to the performance of the business. Because we can't do any kind of an earn-out. We could do a forgivable promissory note that we'll talk about in a second, but it's a large building and the rent is almost $250,000 a year. Well, he has that de-escalating if the volume of the business drops. And they're working on the deal right now. We're going to have that approved and closed hopefully before September. We can talk about that as I get to it. So earnouts are ineligible for SBA financing. What is eligible for SBA financing? So soon as they outlawed earnouts, I had to call the SBA. And I had to say, I need to understand exactly why earnouts were outlawed because I do think there's a reason for them. Well, the 2 things that they told me was, one, we just instilled a minimum down payment requirement, and you can mess with that by putting an earnout in the transaction. So we don't want the down payment adjusted by you by determining your earnout amount. I said, okay. They said, we want the down payment based off the entire purchase price. I said, okay. They said, our second issue is the business valuation. If you're doing that $2 million transaction and 500 is an earnout, the valuation only has to come in at $1.5 million. We don't want that either. We want the value of the business for the entire purchase price and not just excluding the earnout. So I said, okay, I can address both of those things. And these are the 2 things that I came up with back when they did outlaw earnouts. So it's a promissory note, just like any other seller promissory note. It can be tied to gross revenues or wherever or whatever you want it tied to. Like I said, I've seen it tied to, there's one we're doing right now that does have a forgivable promissory note that is tied to the retention of 2 staff members. They are critically important. And the buyer and the seller sat down, both understanding how critically important these 2 employees were, and they did the math to determine what it would take to replace them. And they came out with about $100,000 a piece. So what they said was, we're going to put $200,000 in a promissory note, and if either of these people walk in the first 2 years, 100,000 is going to be forgiven. I thought that was a great avenue. So milestones are determined by the buyer and seller, just like an earnout, whether you want to tie it to gross revenues or the retention of an employee or a retention of customers. That happens all the time too. If I see a 40 or a 50% customer concentration, another great avenue to use a forgivable promissory note. Now, like I said, forgivable promissory notes are typically accepted by SBA lenders. And I have to use the word typically because there is at least one lender I know of in the country that absolutely thinks this is against the rules. I actually have heard of a second one, but I haven't confirmed that yet. But so this is, again, an optional that the lender has to take. I have not had a lender not accept a forgivable promissory note. Doesn't mean it's eligible, and I'm hoping by putting this out there over these last few months, it doesn't shoot us in the foot and just become ineligible. But I have been using these for well over 10 years in a lot of my transactions and have no issue with it. So again, another conversation for your lender. If you're marking down things to talk to your lender about, see and understand if they'll accept forgivable promissory notes. There's no downside to the lender. It can only be an upside. It's a form of seller financing. Go ahead, Steve.
We got a couple questions related to this, and they're great business brokerage questions. One is, so in the event of an earnout or even in a forgivable promissory note, what do you see as customary payment terms for the broker, right? So how's the broker getting paid on that, and what's the basis? And the second question is, it looks like Tony may have worked to use these before, and he's concerned about an objection that a forgivable promissory note has a potential to create a taxable forgiveness of debt to the buyer. So two questions. One is, I like the way the brokers think, right? What's our payday going to look like, and what does that look like? And then Tony's question on taxable forgiveness of debt, if the forgivable promissory note has to be forgiven.
Well, I'm not the tax professional, but I can tell you, right, if that's forgiven, I'm thinking it is some type of a taxable event. There again, that's a money question or one of the CPA questions. But that would be on any promissory note anyway. So any type of seller financing that's forgiven, I think, creates a taxable event on the buyer. But there again, I'm not the professional on there. I don't think that changes. I'm looking for avenues to get the lenders excited or get them to do transactions. So, if it's an earnout, that's just between you and the seller. There's no lender involved, so you can do whatever you want there. But as far as paying the broker, I want my money up front. I'm sorry, I'm a broker. If I'm doing all this work and creatively putting this deal together, and not many people understand or can bring a forgivable note to the table or do this kind of creative structuring, there's a value there. If you're doing this, and this is a huge upside to the seller. I mean, if he doesn't want to sell his business, which is an option these days, then he can take it up. But if it's going to happen in the next few months, then being creative and being paid for it is critically important. I want my money up front. I don't care how much that down payment's going to be. My payment's coming out of that. And I am a big proponent of the brokers getting paid. I don't like to see any negotiation on the fee. I don't like to see any promissory notes for the fee moving forward or anything like that. I want the money. That's the bottom line. Whatever we have to do. The brokers need to be paid. No one understands how hard brokers work like I do. I've lived with you people for 25 years, and if anything, you're underpaid. So I don't want to see you leaving with any kind of a note or anything like that. Unfortunately, Mr. Seller, you're going to have to pay for all this creativeness and effort and everything up front. And I'm taking it out of the down payment. Just my opinion. And Steve, Scott, you can jump in on that. But I want to see you guys make money. You gotta. You make the world go round. I need you to stay in business.
Yep, totally agree. We try to get paid up front. I think the world's going to be interesting for the next for the next 6 months. I think we're all going to have to be a little bit flexible, but in all terms, right? It's right now it's about getting deals done in the world that we live in.
Exactly right. And that's why I'm trying to really think outside the box and give you all the arrows I can. No set level of note reduction. There again, what we did was we sat down and determined those two employees would take about $100,000 each to replace. So, they made a note for 200,000, and it'll all start. I think after the first 12 months, there's a portion that gets paid, and then after the second 12 months, it's a larger company with a lot of income, so it's not a cash flow concern at all. But after 2 years, he gets the rest of his money. And it's only about those two employees staying. It isn't even tied to gross revenue or anything or performance of the business. So there's no set level of note reduction. What we do care about is, well, if you have to perform on this note and make those payments, that the effects on the cash flow are acceptable. That's the only concern on our side. But other than that, there's flexible with no lender involvement. They don't need to know what you're tying the milestones to. Yeah, they're going to get a look at the promissory note, but it's only upside for them. It's only, well, if this doesn't happen next year, which we counted on because it happened last year, well, if it doesn't happen next year and that note's reduced, well, my lender's in a better position. They're not. So that's why our lenders really don't have an issue with this at all. It's only more protection and additional protection for the lender. So we haven't had a pushback on this at all. I hope this is something that you find value in and can use. It's also on our website, I believe, is a sample promissory note with forgivable terms and a couple slides that kind of outline what we just discussed, being the ineligible pieces. So forgivable notes, and here's the downside. They can't be credited to the down payment because they might go away. So for those of you who understand that seller notes could be used toward the down payment if they're on full standby, a promissory note that is forgivable cannot be calculated toward the down payment. It also can't be removed for business valuation calculations, which is one of the reasons why SBA outlawed earnouts. Can't remove from the down payment calculation. So although it can't be credited, it also can't be removed from the down payment. So that down payment is going to be based on the entire purchase price, which is again what the SBA wanted and their intent. And it cannot increase the seller's overall compensation. And this is really the biggie between an earnout and a forgivable note. An earnout can have an upside for the seller. Hey, if that contract comes through, we make extra money, I'm happy to share it, which is typically the sentiment when a large contract gets signed during a transaction or something along those lines. The buyers many times want to share it with the seller. Well, if you're using a forgivable promissory note, that can't happen. That would be in conflict with the rule that states the purchase price is adjusting post-closing. So that's why there can't be an upside for the seller post-closing with a forgivable note. It can only be reduced. So if it's going to be seller financing, you can use an earnout. There can be an upside. If you use an SBA, it's got to be a forgivable note. Cannot be an upside for the seller. So I hope that's clear. Those are really the key factors to these. But,
and I think one of the things that was enlightening to some of the folks I talked to after your talk last week with on the IBBA, right, is that a seller note that doesn't need to be on standby if it's not considered part of the down payment. So if it's over and above the bank required down payment, then it doesn't need to be on standby.
Great point, Scott, and I bring that up all the time. I kind of value the sellers. You know what? When it comes to seller financing, typically, if seller financing is included in my transaction, there's usually a reason for it. Like I said before, I'm against seller financing for a lot of reasons. But even if there is seller financing included, I'm gonna help get him paid. If it isn't counting toward the down payment and that business can afford it via cash flow, then I'll allow the payments to start right away. The only time it's on full standby is twofold. There's either one, it's on standby for the life of the loan, which would help with the down payment, or B, it's on standby because there's a cash flow concern and we can't afford to pay it based on the coverage ratios required by the lender and or SBA. Well, in either of those scenarios, like I said, the seller should be paid. Even if I have to do, let's say it's not counting toward the down payment, but I'm going to include a 10-year seller note. I'm going to balloon it after 5. Personally, I think a seller should not be involved in the business longer than 5 years. So even if my buyer comes to me and says, I've negotiated a 10-year seller note. Well, if it's cheap money, I might allow that to stay. But if he's doing that just to help our transaction happen, whether it's be to lower the loan amount, to get it in the lender's parameters, or whatever the case may be, I try and explain to my borrowers, you should be thanking the seller. He's helping us make this transaction happen. And without that note, it wouldn't happen. So whether or not you're going to make payments to him initially, you should try and balloon them after 5 years and get them out of the deal, in my opinion. And I do, like I said, preach that to every buyer that comes here with a seller note. But yeah, and we won't get into my philosophy on seller notes, but my biggest pet peeve with seller notes is the effects on the cash flow. If I'm a 10-year loan and the seller only wants to hold paper for 3 or 5 years, I don't want to double my payments. So, and that's what I preach to all my clients. I'm trying to increase the annual cash flow to a buyer. So that's my basic for anti-seller notes. So here we get into the PPP loans. What does this mean to the broker and the acquisition market over the next 6 months? All right, and I'm sure many of us have experienced this where lenders have gone on hold for months. We have picked up pieces from transactions all over the country because, well, the lender pulled the commitment letter and they won't reconsider it until July, or they're putting it on hold or reevaluating it, or they have new documents they need filled out. So I don't know where this is going, and I can talk a little bit more about the lenders we work with and what I'm hearing. But most lenders that we're working with have adjusted their underwriting criteria already. They're already starting to tighten up. What was ironic was when this first really hit, I went around to say, what industries are we going to be concerned about? Because for those who lived through the 9/10 crash, there was an industry list, which was basically a blacklist. If your industry was on this blacklist, your loan wasn't going to happen. So right away, I went to the lenders and said, well, what kind of industries are you really concerned about moving forward? And they defaulted to the 12 list, which is incorrect because they had construction companies on there and a lot of things that actually are not affected during this time. So I'm already trying to tweak all their lists saying, you know, accounts are not concerns and constructions are not concerns. I have been personally monitoring 3 different construction companies in 3 different states, and they're all as booked, if not more booked, than they were before COVID. I actually drilled down to find out, you know, why is that? Well, people are at home, they're looking at their ugly walls or their ugly screened-ins or their ugly pieces of house, and they're thinking, well, I'm home. If construction people are going to be here, it's a great time. But the companies I'm monitoring are all up. So I'm not having a concern in the construction industry right now. So, you know, they don't know what their underwriting criteria looks like either. Like I said in the beginning, I think that the fault is, well, let's just increase down payments, increase collateral positions, and, you know, tighten up right now just to be sure, which, you know, I think is not accurate or appropriate, but we're not the lenders and we just got to follow along. So let's talk about the lending markets in today's world and what we expect to see over the next 6 months. You know, it's all about your relationship with the lender. I really think this is an opportunity, not only for business brokers, but for lenders and for relationships, because I'm sure there are lenders that all of you work with on a regular basis and have done many deals with. Well, now's your opportunity to talk to that BDO, that salesperson, that lender, and understand what their criteria is. And really what I look for is, well, are they shooting straight with me? Because there are, and we all know them, lenders out there that will promise you the world just to get a look at your transaction, even though they know that they can't do it. Well, I'm a big fan of giving them enough rope to hang themselves. So this is a great opportunity to put that out there and understand their lending criteria and see who's being honest with you, who cares about your business, and who cares about you making a living moving forward, as opposed to, you know, we have seen, we've picked up pieces where they had promised them that they would get them a commitment letter in 2 weeks, and they knew that underwriting was closed for 45 to 60 days. Well, why a lender would put that out there or even say anything like that? That's just being selfish. So I have a real problem with those who are misleading or not being honest and upfront with brokers. And this is a great opportunity to understand who is and who isn't. You know, the ones that are your friends and the ones you want to do business with, or the ones that are shooting straight with you and trying to teach you how their underwriting is going to look when it does come back, if it isn't back, or maybe working together to say, hey, we can push this deal off for 3 or 4 weeks. Can you get it into credit, the first week of July? This is an opportunity to build and create that relationship with your lenders on a different level. And that's critically important as you're moving forward, and especially coming out of this, okay? Because we're all going to need to do a lot of transactions the second 6 months of this year, the way I'm looking at it. So how can you adjust to make a difference today? It's being proactive. That's really what it is. This, like I said, is an opportunity. I'm seeing the most active brokers not sitting back on their hands. I see them actively talking to their buyers, their sellers, their listings, their previous customers. Here's one of the rules that is really your selling item for the next few weeks anyway. Borrowers who obtain, and this is included in the CARES Act, all published on our website if you need to read it, borrowers who obtain a new loan under these programs get 6 months worth of payments. I mean, I'd love to see a show of hands, but who doesn't know that if you close your loan by 9/27 this year, you get your first 6 months worth of SBA payments paid for, not deferred, not you owe later or anything like that, paid for. Well, we have a few weeks left, probably 3 or 4 weeks is what we're talking to our borrowers about as far as getting these loans in and getting them approved so we can make sure we're closing by September 27th. But that's in the CARES Act. You get 6 months of payments. One of our clients is going to save $249,000 by closing by September 27th. That's 6 months worth of his payments. That's big money. But these are conversations that you can have with your potential buyers and with your potential sellers. If there's a seller on the fence, you got to tell them to get that listed, because this is a huge incentive. We're getting calls from potential buyers every day saying, I got to find a way to get this business closed before September. I have one broker that actually, one of his deals was put on hold for an additional 30 days of due diligence. And we may all be seeing that a lot. That's the big talk is, well, let's just put an additional 30 or 60 days worth of due diligence. Well, he went back to that borrower and said, we can't allow that to happen because we have backup borrowers, backup buyers on this business. And we want someone to take advantage of these 6 months worth of payments. So we're sorry that we can't give you the additional 30 days worth of due diligence. You either have to move forward or allow us to talk to the second buyer because of these 6 months.
Hey, Steve, so a couple questions related to some of the things we've talked about. And so the question is, does the 6 months of payments on this SBA note apply to 504C for real estate acquisition as well?
I can't answer that. It does say 504 and microloan programs. They're usually lumped together. And let's see, this is the actual verbiage in the rule, so we can read it here. Interest and fees on existing SBA loans for 6 months prior to 504. Okay, borrowers who obtain new loans on the program. It doesn't say specifically 7A, so I would have to believe. I do believe they got 6 months worth of defer. No, their payments were made also. That happened as soon as the CARES Act became law. Everybody who had an SBA loan was granted 6 months worth of payments. So I do believe it does affect the 7As and the 504s in the real estate loans. Everything that is included in the 7A 504 program is my understanding of what I just read.
And sounds like if you have something like that in process right now, is that I'd be talking to the lender, to your local lender, and getting on top of that. And sounds like Hal has a deal going where he's got a seller that has an EIDL loan. We haven't talked about EIDLs, and I don't know if it's on the agenda or not, but it sounds like he's got a deal going, and the seller's got an EIDL loan. The buyer is okay with it, and so the question is, can we assign that loan to the buyer? The buyer's happy to take it.
I do not know if the U.S. Treasury is allowing assumptions on those. I can tell you on the SBA side and the lender side, all of our products are assumable, including the PPP. The idle loans is a liability. Now, what we're saying and what we're preaching on acquisitions is it has to be paid off the closing just like any other liability. But that's a U.S. Treasury issued loan directly. So what their rules on the EIDL, I haven't spent a lot of time, to be honest with you, on the EIDL loans, because those are typically for businesses that are staying there and not usually in transitions. So I'm not real familiar with it, but everything in the SBA world is assumable. including the PPP. Now, whether the lenders will do it or not is a different story. So what we're preaching is on the idle loans, they must be paid off at closing. So we're including it in our transactions and just paying them off. If there's SBA financing, they have to check with the U.S. Treasury because, like I said, that's who actually issued it.
Got it. And how about, you know, in some of these smaller deals or any trends you're seeing in terms of landlords and leases? Those of you who come to our Austin TABB meetings know that I put landlords and leases almost at the top of my list of things that screw up deals here in Austin, Texas. But with all the changes in commercial real estate, you know, are you seeing anything relative to landlords and leases and you know, lease rates going down, or what's your thinking there?
I can tell you locally, the landlords are doing everything they possibly can to keep their tenants. You know, here, and I guess like everywhere, malls are empty. So anyone who owns malls is sucking wind, and they're losing what few stores they have. But as far as the strip centers, those are the ones I'm concerned about. I don't want to see, you know, half or three-quarters of a strip center empty when there's 15 or 20 units. What we're seeing here is the landlords are cutting the lease and rents to the bare bone through this. And a lot of times, I have one major landlord right here in the Triangle that has actually said, all I need to cover is the taxes and the utilities, and I'm going to split that amongst my tenants while most of them are closed, and we'll figure it out later or not at all. But now that's a large landlord that has a lot of properties around here and doesn't probably owe a ton of money on their buildings. The bigger concern is those that are leveraged and can't afford to make those payments. But I do believe that landlords are going to have to do a little bit more negotiation. And it's kind of funny you mentioned that because we've watched that cycle over the last, 10 years, where around here, you know, they couldn't give space away. Then it became a premium and you couldn't buy. And now I think it's coming back around. Yeah, they were kicking tenants to the curb because they had 5 lined up right behind them. And now all of a sudden, I love to see that change again. But now I am seeing more vacancies, especially with more of the online stuff going on. So I think landlords have to be a lot more flexible and a lot more understanding right now, especially with their tenants that are closed.
And going back to the PPP loan, right? The PPP loan is an assumable note subject to the issuing bank agreeing to it, right? But what's that mechanism like in an asset transaction, right? So you got the new co buying the assets of, you know, the PPP company, right? And they're willing to assume the PPP loan subject to the bank. What's that mechanism look like?
Well, we had one that we were in the middle of, and the broker actually called me and said, we're just going to have the buyer assume it. The problem with our side was it was $350,000, and we didn't want the additional liability on it. Now, they did go back to determine that the lender said, we're not going to allow them to assume it anyway, which no one understood why. But the one assumption that we did try to get done, the lender came back and said, we're not going to approve it. So what we had to do there, well, we had to get a little bit creative with that one. But because we wanted the borrower to take advantage of that, and the seller wanted the PPP money to get to the borrower. So what we did there was I did a little creative thing with an escrow account. What we did, because we were allocating the funds to support the company, so my borrower had no reason to need that PPP, and the business was a large accounting firm. So she was fine, but it was, like I said, $350,000. So what we did, and he had already paid a lot of his help, but they needed to work together for the forgiveness piece because some of the staff was his and some will be turned over to her. So what we're actually doing, or what we did, was we just let him keep the employees and her lease them from him while the PPP money was still paying for those employees. But here's the caveat. What we did was every payroll that he made after the closing, she had to mirror into an escrow account. And the thinking was, come forgiveness time, if it's forgiven, then she gets all the change left in his account for the PPP money, and she got all that labor for free. If it's not forgiven, well, he has to then pay for the labor that he used, which was a legitimate thing to do, and her escrow account should be the difference that she owed for the labor that she used during the PPP funds. So there were no liability concerns on either side. And that's how we got around that one.
That's a great creative way to get around that one. It looks like we've got, some other folks doing some creative things, a little bit off topic, but the question is, we get to creative deals, right? If a borrower needs to, borrow private money for the down payment, now in my experience that has to be disclosed, right? But if the borrower is borrowing private money, so he's going to borrow money from Uncle Joe to cover a part of the down payment on a separate note, right? What's that? And what does that look like in terms of how does that roll into the transaction and relative to disclosure and payment terms, etc.?
And we see that all the time. There are two optional ways for the down payment to get to the borrower in our world. Now I'm only specifically directing it toward SBA type transactions. So it can be either a gift from a family member, or it can be injection from a minority owner. The down payment on an SBA loan cannot be borrowed by rule. So I'm taking Uncle Leo, or I forget his name, and I'm going to make him a 10% owner. At 10%, he isn't guaranteeing my loan, he isn't putting up any collateral, he isn't signing anything, but he can put in any or all of the down payment because he's the actual owner. Long as, and this is the SBA rule, as long as his equity interest remains under 20%, and we can prove he's not directly handling any kind of business operations, then I can keep Uncle Leo completely protected and let him put in his down payment.
So, any restrictions on then the buyer then buying out that minority equity ownership?
Oh, well, he could do that down the road, but Uncle Leo cannot be repaid his down payment injection. That's going to hit the balance sheet as equity. It could hit the balance sheet as a loan from shareholder. If it hits the balance sheet as a loan from shareholder, Uncle Leo is going to be signing a subordination that says, I won't take any of this money back until the SBA loan's paid back. Or if it hits the balance sheet as equity, he signs a form that says, my equity position will not be reduced for the life of the loan. Now, that said, Uncle Leo can make $150,000 a year. Paycheck-wise, or distribution-wise, or consulting-wise, or however else you want to pay Uncle Leo, that's perfectly legitimate. There is no restrictions on how much money Uncle Leo makes or anything like that.
But to buy out his equity portion, you have to wait until
about 2 years. Usually a partner buyout is usually showing you have the equity for 2 years or more. But he's still going to have no equity. We're not going to be able to do that if that SBA loan is still in place. We're not going to be able to buy out because there'll be no equity after that. So, his injection is going to be there for the life of our loan. Like I said, put him on the payroll, make him a consultant, make him an advisor you call once a week, whatever else, and find a way to take care of Uncle Leo.
Gotcha. Hey, we've got about 5 minutes left. I'm not sure what you got left to want to talk about, but we've hit a bunch of it. So if you want to fly through the final stuff you've got going.
Well, I want to talk more about your selling features, okay? If you do have a buyer on the fence, calculate the 6 months worth of payments, which is what we did with our $249,000 guy. And we said, look, you have to close, okay? They'll pay full 6 payments. If the loan is, now it says made by 9/27. I was trying to find out if I could get a PLP number, but no, the loan must close by 9/27. Every potential buyer needs to be made aware of this. I mean, if they're looking at any kind of transaction, size, this is a big number. These are conversation starters with everybody. Everyone you're talking to should know this. Listings, sellers, buyers, everybody. Previous buyers, okay, they got 6 months worth of payments for free. Current and potential sellers explaining why it's a good time to sell. We're seeing a lot of transactions where the seller says, I don't really want to live through this. What that raises in my world flag-wise is it's opportunities. Well, if I'm seeing a lot of sellers that don't want to live through this or have lived through this once or twice before and are just done, I'm seeing sellers being a lot more flexible these days. Again, opportunities, all right? We have to find opportunities. The buyers can take advantage of the 6-month payment inclusion. Business value has not been reduced from a lending perspective as of yet. So we're watching the business valuations, but right now we haven't had one stop one of our transactions. Is that going to change? I don't know. That's why I brought the valuation rule into effect today. Will the value of the business reduce? This is the big unknown right here, and this is your conversation with your sellers. What are your financials going to look like in 2021? All right, do you want to live through this? Well, come December, what are my 9 months worth of 2020 statements going to look like? Because you will close for 3 months or 2 months or 6 weeks, so no, this is the unknown. So if you're talking to a potential seller, you got to tell them now's the time to sell. You got to sell today, because we know next year is going to be ugly on some level. The talk amongst lenders is, are we going to replace those 3 months with 3 months worth of 19? Are we going to use 9 months worth of 2020? And I'm sure on some level the SBA is going to have to address this, because it's underwritten off the last full year tax return in theory. We're not going to have one. What will lenders consider for cash flow in 2021? Nobody knows. So that's why it's a great conversation to have with any potential seller. I mean, I don't think it's going to shut all of our businesses down for 2021, but I still don't know what it's going to look like. So here's your opportunity. Taking the time to relay this information to your customers and provide guidance throughout this, invaluable dividends. Now is the time to have those conversations. Maybe it isn't about closing every single deal that you're working on, but it's about sharing that information, getting those people to understand what we're dealing with and how to best position themselves moving forward, both from a broker perspective, a buyer perspective, and a seller perspective. So,
and I like the way Kimberly thinks. She looked, and 9/27's a Sunday, so she's thinking it's 9/25. We just lost 2 days.
There you go. More bad news. I know. So that's why I'm telling people, we have to have those loans in by first week of July, maybe the 2nd. So if you have buyers on the fence, you need to tell them, pull the trigger or not. Figure it out later, but sign an LOI. But hey, let's all, we know whenever crisis happens, it opens up opportunities. Now's the time to find those opportunities and create those relationships, understand your lender's positions. There's a lot going on. Become the expert for all of these people moving forward. So borrowers don't automatically have to place their collateral. Earnouts not eligible for forgivable notes are for SBA. No, understand your asset values, because that may play into a part. Low business valuations might not kill your deal. And low appraisals might not be deal killers. Those are all important things for you to know these coming months. Talk to your lender, find out their situation. There is the easysba.com is our website. You can go to the top. It says webinar information. There's a bar that runs across it. If you want to see, there is too much information on our website. Every single update that's come out for the PPP and the EIDL loans and the forgiveness application, everything is up on our website. So you can always visit us at easysba.com and find all of those things. But it's an opportunity. Let's go out there.
We're right about at time, and we've got one last question, and it's come up a couple times. I think it's an important question. So both in an earnout scenario and a forgivable promissory note, let's just take a hypothetical example, right? The deal is going to be $1.5 million with a $500,000 forgivable promissory note, or take your deal, $200,000 forgivable promissory note. So total value of the transaction's $1.7 million, but for lending purposes, right, it's $1.5 million, right? So from a broker perspective, right, should the broker be expected to pay on the $1.5 million or the $1.7 million? And obviously we all agree we want to get paid up front, but what's that discussion like with the seller, right? I'm saying, well, look, the transaction's $1.7 million, I should get paid on $1.7 million. The seller's saying, yeah, but that $200,000 isn't guaranteed, so I'll pay you on the $1.5 million, or maybe I'll pay you on the $1.5 million now and the $200,000 if I get it. What's that dialogue like?
I love that. Well, first of all, I would love to hear how you do it now when there's a seller note included, if it's, 10% or whatever else. But my opinion is the selling price is still $1,700,000. That didn't change. These are the components that are going to make up the financing piece to get this guy the most money you can. If you're the hero, you need to be paid on everything. And so we go back and we say, okay, you don't want to pay us on the 200? Well, then we're not going to, you're bringing all of these pieces to the table. Without this 200, the deal's not going to happen. That's how I look at it. I always look at where is the cause of the concern. Well, if that $200,000 note was demanded by the lender or it's raised because of some concern from the buyer, I look at that as a seller issue. It's their fault. Now, you're not holding that 200 to help him with the down payment. That's a different scenario. But if you're putting 200,000 into a seller note because of forgivable, all right, that means there's an issue in my mind on the seller side. Like I said before, maybe it's those two those two employees that have the ability to walk and cripple the business. Well, everyone recognizes that. That's a seller concern on my side. It's nothing the broker should be penalized for. The broker's the one that's doing all this creative work to make this deal happen. And if it's a $200,000 seller note, that's the difference in making it happen or not. I still think the broker is the hero. He's the one that came back and said, look, we can't make the transaction happen, but if you hold 200 grand, I can make this happen. You're still the hero, and you should be paid on $1,700,000. I don't care if they're holding $500,000. You should be paid on $1,700,000. That's the transaction value. So,
and how about in an earnout scenario, right? Where you got a fast growing company, you got a baseline of $1,500,000 with an earnout that you're gonna get paid additional money if to take it to $1,700,000, $2 million, $2.5 million, over the part of this earnout period. What have you seen there in terms of structuring broker compensation?
Well, there again, if there's an upside for the broker, well, now we're talking negotiation, because you're right. Instead of my fee being 100, if I have an opportunity to make 130, but I'm going to leave 50 out there in an earnout or something like that, now I'm reevaluating the transaction as I'm the seller, because I am. What are the chances of that contract coming through? And I'm going to look through all of that. And if there's an upside, I'm a negotiator, and I'm also a risk taker. So you know what? I'll gamble on that if there's an upside. If there's going to be an earnout with an upside, maybe I'll hold some of the paper if it's less important to me. If it's a $100,000 transaction and we're talking about holding a $10,000 note, I am not negotiating my fee.
Yeah, that's a great point, and I think the answer there, right, is you've got to look at what the cause is, what the situation is, what does it take to get a deal done, and I think we're all going to have to be fairly creative moving forward in order to get deals done. We're going to have to stay on top of the changes, right? When the PPP first came out, I said I should have listened to the first webinar and considered myself an expert, because every additional one that I listened to, I became more and more confused as things changed, right? So the only constant in our world right now is change. And we're going to have to stay up with the change, stay informed of the changes, but also collect our resources, the resources that we trust, to gain information so that we can bring these tools together in order to get deals done. So, Steve, thank you so much. I think we're at the end of our time, a little bit over. Greatly appreciate it. It was really good information. Thanks to the nearly 100 of you from coast to coast that joined. Sam asked for my contact information. I'll go ahead and send that out. Or if you want, my email is Scott, SCOTT, @Tilus, T as in Tom, Y as in yellow, L as in Larry, A as in Apple, S as in Sam.net. Scott @Tilus, TYLAS.net. My mobile phone number is 512-689-0958. That's 512-689-0958. So again, I'll send it out to everybody. I think we've got this recorded. I'll work with Steve and his staff to figure out how to get it out to everybody. And again, thank you so much. Appreciate it. Everybody stay safe, stay healthy, and make it a great day.
Thank you, Scott. Thank you all. Go change the world. Okay. Bye-bye.
Bye.